Okay, this is panel 2. It's the panel for Europe. And we have representations from the UK and Germany and Pittsburgh here. So, figure that one out. Okay, so we're going to, in Europe, what they really have accomplished a true passport. And also, they really have accomplished in trying to impose a severe regulatory regime modeled after this great regime we have in the US called the SEC. And those who have to deal with it knows that, you know, our clients in Europe who usually had a free pass and a lot of regulation no longer have that. So welcome to the club. And let me start with probably the UK. And two of my partners here, we have Sean Donovan Smith and Philip Morgan, both from our London office. And also we have, next to them, we had Todd Gibson, who recently joined us, who spends half his time in Boston, the other half in Pittsburgh, who focuses primarily on offshore issues. Let me ask you, can you operate in the UK without having any type of regulations? Can you do reverse solicitations? Can you fly in, fly out? Do you have a do's and don'ts list? What would you tell people to do?
Many of our US clients, US fund management clients, want to market their funds and their investment services to institutional and professional investors in the UK. And by and large, they are able to do that without being FCA authorized. That is on the understanding that they don't have a physical establishment in the UK. As soon as there is a UK office or a sort of any kind of permanent presence, then at that point you will need to be FCA authorized. Pending that time, you will need to comply with financial promotion rules in the UK. To the extent you're marketing, though, to institutional and professional investors, you will most of the time be able to fall within exemptions from the financial promotion regime. An important rider to that, which is very topical at the moment, is the Alternative Investment Fund Managers Directive. So, and I think we'll come on to that in a moment, but that directive is setting out a specific regime for pretty much any investment fund that isn't a UCITS fund, and sets down specific requirements in relation to the marketing of those funds. And that applies in the UK in the same way that it applies in Germany and across Europe. I say in the same way, there are some subtle differences. So you do have to think about financial promotion, and in particular in the fund context. As soon as you do come into the UK, you have to start thinking about FCA authorization some more. That includes when you're flying in, flying out. Once you're physically in the UK, if you're, in particular, if you're what we call arranging deals in funds, then you would need an FCA authorization. There are ways of approaching what you do when you're in the UK, such that you can avoid that. You know, most of the time, but once you are physically present in the UK, in particular for any sort of extended length of time, then you do have to start worrying about this. One way to deal with that is to employ a local FCA authorised firm, either to go round with you when you're doing your marketing, or otherwise, of course, to do the marketing themselves on your behalf. That would equally work. I don't know, Sean, whether you want to talk about AIFMD or.
Well, what I was going to add to that is just continuing on from that activity. So what you're looking for is if you're carrying out a controlled activity within the UK by way of business, then you're potentially caught by FCA regulation unless you can rely upon an exemption. And that whole aspect of what's happening in the UK can be a concept that does trip up some of our clients, because you get concepts of, do you have a place of business, do you have a permanent establishment, and you get a mixture of regulatory interpretations with taxation interpretations sort of coming together. And so it is certainly possible to trigger off having a place of business for the purposes of FCA regulation simply by paying the expenses on someone having a regular office that they occasionally use within the jurisdiction, and even paying expenses on a house, so the rental expenses, say, on a house, can also trigger it off. So there are some areas there that you need to be alive to. So the thing to do is to ensure that you're operating within the exemption to FCA regulation. And as Philip mentioned, I think there's a function of looking at two things: the marketing promotion itself. Are you making what's called a financial promotion in the UK? And you need to fall within certain exemptions to that. For most institutional investors, that will be readily available, that you can rely upon. And then the activity itself, the most likely of which is the arranging activity that Philip touched upon.
One thing I would say that actually I think distinguishes the UK from some other European jurisdictions is that if you are doing, let's take discretionary management, and you are making your management decision in the US, the UK will regard that activity as being done in the US and not in the UK for regulatory purposes. I think what you will find in some of the European jurisdictions, and I haven't actually asked about Germany, but in some of the European jurisdictions, if you're doing discretionary management, taking the decision in the US for an investor in, let's take Sweden, then the Swedish regulator will say, you are doing investment management in Sweden. But from a UK perspective, on that particular issue, that's not how we see it.
Let me say, a lot of references were made to Germany there. Let's have the Germans defend themselves on this thing. Come on. All right. So I'm going to ask two of my partners. I have Dr. Christian Busch and Dr. Till Falk to talk to us about the German markets. From the U.S. side, a lot of U.S. fund managers set up offshore funds, usually in Cayman, BVI, Bermuda. And they use those funds to access the German markets. And I know for many, many years, they used to do this through a private placement exemption. And now with AIFMD, the whole world, at least the European world, has been turned upside down. And there's a lot of confusion, misunderstanding from the US side of what you can and can't do in Germany. And it seems like the UK colleagues are spurring you on questionable about some of these practices here. So could you defend yourself and tell us what the real story is?
Yeah, I mean, the story was quite real. As Philip pointed it out, that's probably one of the differences that we have between the UK and Germany. The AIFMD allows their member states, I mean, it's a directive, it's a European directive, and it has to be implemented by each member state. So that means, although you have a directive on the European level, you still have national legislation in each of the member states. And as the directive is basically a goal that has to be obtained, I mean, there are different ways on how to obtain it. And so one of the provisions of the AIFMD allows the member states to retain their private placement regimes, and throughout the European Union, the member states have made different use of that option. Germany, for example, decided not to uphold its private placement regime, and so that means with the coming into effect of AIFMD in Germany in July of last year, there is no more private placements in Germany. So that means once you would like to sell your funds in Germany, you would have to think about other options that you can pursue. So that means what you can do, obviously, I mean, there are different ways, and Germany has decided that they will opt for the Article 42 marketing of funds into Germany. So what you can do is, if you are a U.S. manager and you have funds established in, for example, in Bermuda or Cayman, I mean, these are the traditional funds that are marketed into Germany, or you can market them under the requirements of the Article 42, but there is no more private placement.
And should we just say briefly what those requirements are under Article 42, because they apply in the UK as well. So you have, and some of you will have been dealing with this, you have disclosure requirements, mandatory disclosure requirements under AIFMD in your pre-investment disclosure document in your prospectus. So for quite a number of clients, we've been reviewing prospectuses and doing gap analyses versus the AIFMD requirements. There are mandatory AIFMD requirements relating to content of your annual report to investors. There's certain periodic information requirements that you have to give to your investors, and importantly, there is a reporting form to European regulators, and it's a form that needs to be called the Annex 4 form, not totally dissimilar to Form PF, and it's a form that you're going to need to be delivering to the regulators in each jurisdiction in which you are marketing your non-UCITS fund. And I think Germany, in addition, has some sort of bolt-ons to this as well.
Yeah, that's correct. So so Germany is always a little different. It appears. I mean, if we talk to our UK colleagues, they always say, well, Germany is different. They have always something more than we have. And so what we have more is...
less is more.
Yeah, sometimes less is more, sometimes less is better. But so what we have more is we have a requirement that is the depository function that needs to be implemented. So what is the depository function that needs to be implemented? The AIFMD provides for a depository function that is quite, I mean, it's quite comprehensive. But the German legislator, they have said, I mean, if you're a third country AIFM and marketing a third country AIF into Germany, we cannot ask you, to comply with the full requirements of AIFMD. So what they have implemented is some kind of a depository-like function. And that depository-like function comprises essentially two items. And the first one is you need to have like an independent depository, and that depository has two functions. It needs to monitor cash flows. So that means the money that comes in from the investors, and the money that goes out to the investors, and the money that is made for investments. And what they also have to do, they have to verify that the assets that are actually in the fund are actually in the fund. So for example, if you have securities, I mean, the securities would have to be held with the depository. So if you have, for example, real estate property, they would only make sure that you actually, acquire the property, like a legal title to the property. That is the depository function. But obviously, I mean, the requirements are not too high for the depository function, but obviously, I mean, that's what we have observed from our clients. I mean, that is essentially one of the requirements that hardly anyone wants to comply with, because it's like additional regulation that they have not for their standard for the standard AIFM investment funds that they have established in Cayman or in Bermuda. They just don't have that, and it would be so much of a burden to do that. So many of our clients, they ask, how can we get into Germany?
I think it's important to note, people use the term, and that's in the directive, an alternative investment fund, and you don't naturally think of, say, a U.S. registered investment company as being an alternative fund, but under the directive it is, and there are a number of U.S. managers that have sold their U.S. RICs to European institutional customers in the past, and now that's caught within the directive, and there's no mechanism for non-EU managers to register, so you have to be relying on these national private placement regimes. So that's kind of an area to watch out for. The other area, and this might kind of segue into a little bit of the delegation rules, other ways U.S. managers might get caught. And what that will mean is, we were talking earlier about because I know there's some folks in the room that manage German special funds, which is a special type of German vehicle that is considered an alternative fund, and under an outsourcing arrangement, those are also referred to as alternative investment funds. So.
Can I just quickly say, just to put some of the different regimes into context that we're talking around, is since the late 1980s, there's been a regime for UCITS funds in Europe, which are basically a 40 Act registered fund equivalent in Europe. That's been around now for some time, since the late 80s. And in the summer of last year, a regime was then introduced for all other funds. So you have the UCITS regime that sits there, and then you have now the alternative investment funds a manager's directive that is, technically applies to every other type of fund that you have within the European Union. And so it's applying generally private funds, both open-ended and closed-ended, but there's also another regime that's existing called the Prospectus Directive compliant regime, which is basically for listed funds, funds with public offering, but they're only for closed-ended vehicles as well. But some of those can also sort of trip over into the Alternative Investment Fund Managers Directive requirements. So you have a lot of crossover because of some of the history of the way the AIFMD has been introduced. So I mentioned that just to put those different terms that you're hearing into context. So they sort of sit there a bit side by side, but they do cross over a little bit as well, particularly when you're looking at closed-ended funds. And we could get more into the delegation bit. I suppose it's also worth saying in the UCITS regime, there's been a long-standing passport for the marketing of UCITS funds across other EU member states using a registration mechanism, which was revamped in 2011, which make it a bit easier, but you still need to do certain filings in member states. But the passport that's in the Alternative Investment Fund Managers Directive is only there for onshore EU funds managed by EU managers. So a Cayman private fund managed by EU or non-EU manager is not eligible for the AIFMD passport. So that's another thing to keep in mind, or at least not yet. And there is a proposal to roll out the passport for non-EU domiciled private funds at some point in the future, but that's yet to be put into stone. And although I think the expectation is that that is likely to happen, we don't know for certainty whether or not that will happen.
By 2015 it is expected, but you never know. European legislation takes long, oftentimes.
Yes.
Until let me ask you, in Germany now, I mean, it's a very well-developed funds market. It's probably one of the most developed, I guess, in Europe. Is there any way to bring non-EU funds into Germany other than through like a reverse solicitation?
Well, yes, we of course have been thinking about alternative ways to bring non-European funds into Germany, since now that we no longer have a private placement exemption. One way is what's very popular in Germany is to wrap funds into security type notes and have those distributed in Germany. That's a very common structure that up to now has been used in Germany, mostly for tax reasons, because you wanted to avoid the specifics of the German fund taxation regime, which you could by inviting investors not directly into the fund, but subscribing for some node structure which then would be linked to the fund itself. That could also be used now, or the other consequence now under AIFMD is that these wrappers, that these node structures don't fall under the placement rules of the implemented directive. And the other alternative that we think is there is to simply set up something which is based in Germany that would either feed into your fund, into something which is established outside Europe, or maybe have a parallel fund vehicle also established in Germany, because Germany has made use of the possibility under the directive to exempt what we call sub-threshold managers from a full license and full application of the directive. Sub-threshold meaning that if the vehicle that you set up is below a certain threshold, which depends whether it's a leveraged fund or whether it's an unleveraged fund, it's 100 million or 500 million. But if you manage to stay below these thresholds, then you can set up a vehicle in Germany which is more or less not subject to these rules. You simply need to register the fund as a self-managed AIF, and then that vehicle could then either feed into your master fund or could invest in parallel. That's a structure which we think should work, and we discussed it with the German regulator. It seems strange that it's so easy to get around, but I know what my friends from the UK say, whether it would work from a UK perspective. Of course, it's important to understand that this doesn't bring you into any passporting situation, so you would not be able to then have such a structure also being rolled out in other jurisdictions. That is something that you would then limit or need to limit yourself to German investors. Sorry.
Let me then change this a little bit. Remuneration. That word comes up a lot when we talk to U.S. advisors when they're thinking of managing a fund that would be subject to the AIFMD. And also what happens if they're acting as a sub-advisor? Are their portfolio managers in the U.S. going to be subject to remuneration rules? Let me just open up to the panel overall on that.
Right. Okay, I'll have a go at taking that one first. What I say as a high-level comment is we've got the remuneration requirements that are woven into the Alternative Investment Fund Managers Directive. Those are coming online now for reporting periods that are triggered by the first, after the first full reporting period once you've become a registered or approved AIFM for the purposes of this directive. So we're really looking at periods that are going to be the back end of 2015 that you're going to start to have to report and comply for that the full annual performance period in question. Then we also have proposals in the what's called UCITS 5 to do something very similar, which have been approved at a political level. They are now going through a process of being implemented. It's not likely that implementation will be completed. Probably my best guess would be early 2017. So you're then looking for maybe add another 12 months to that, and then you're looking at sort of reporting and compliance sort of end of 2018. So there's a little bit of time there. And there's potentially some differences in how the UCITS remuneration requirements are going to be applied compared to the Alternative Investment Fund Managers Directive requirements. So now, just drilling down into the requirements themselves, the most contentious element is what we call the payout process rules within the directive, which require that 50% of any variable remuneration is deferred over a period of 3 years, and then that the 50% is deferred, 60% of that is put into units that are either part of the fund or linked to the performance of the fund in some way, and the retention periods have to be a minimum of 6 months before you can start to release those elements that have been deferred, and there's a clawback provision as well if there's negative performance. That sort of concept is generally met with well, I'll say consternation. I think stronger words are probably used generally when it comes up. You know, interfering with portfolio managers' remuneration, particularly over here in the United States, is seen as not a particularly good thing to get involved with. And so we have a lot of discussions about this in terms of what does it mean. And so if you're sub-advising at the moment to a private fund that has an EU-based AIFM, you're potentially going to be subject to this because the regulations that support the directive go on to say that if you're delegating, you need to ensure that your delegate is subject to the same or equivalent rules. So if you had something called a MiFID investment firm, that would be equivalent, you'd be fine. But of course, there's nothing like MiFID or the Capital Requirements Directive here in the US. So can you use sort of Dodd-Frank as saying you're equivalent? I think the general answer to that is no. So then that kicks in another element to remuneration requirements, which is if your delegate is not subject to equivalent rules, then you need to contractually impose them upon it. And this also creates an area of lively discussion that we have quite regularly and have had several today as well. And then you need to start looking at to what extent can you minimize the scope of that. And I might actually park further discussion on that and let Philip talk about that in a second. I'll just talk just briefly on the usage side, and then maybe hand over to Philip on looking at how you apply. If you want to pick up on that point we were talking about earlier. And on the usage side, one of the key things that I want to mention is after quite a lot of debate, there was also a proposal to have an outright cap on bonus payments under the UCITS 5 proposals. That was defeated in a very remarkable sort of European parliamentary move that is not seen often, where it was a coalition of disparate parties that don't normally work together actually came together to sort of see this off. And you usually don't see that sort of amendment happen at European parliamentary level either. It's usually something that happens more in back rooms at European Commission level, that sort of fundamental change in a proposal. So the cap went away, but the identical payout process rules are also now going to be introduced in the UCITS world. And I know many of you are involved with UCITS funds or providing services to them or sub-advising to UCITS managers in the EU. The one thing I wanted to mention, and it's really just to flag it up as something to watch, we're hoping to get clarity on this within the next couple of months from the European Securities and Markets Authority, it is rumored, and I do stress rumor because we've not seen anything in stone, is that the European Commission and ESMA may limit the application of the UCITS rules to just the UCITS management company, and so it won't flow through to a delegate. That would be excellent news for any sub-advisor based here in the States that's interacting with those funds. We don't know if that's actually going to be the case yet, so we're watching that very closely. So just throw that out there. So there might be hope if you're sub-advising UCITS funds or looking at sub-advising UCITS funds that some of these requirements won't attach to you. But even if they did, then I'll hand over to Philip to sort of talk about some of the ways you could look at how you would actually have to apply those rules to the relevant staff and the activities of the fund management operation.
Yeah, so there are a number of ways. If you are therefore a delegated sub-advisor of a European-based AIFM, these rules, you may be required to comply with these rules by contract, as Sean says. And the part, as he also says, that you'll be most concerned about are these payout process rules. But there are a number of sort of hoops you need to get through before you actually finish up having to apply them to anybody. The first I'd mention is that there is in the UK, there is a sort of de minimis requirement. So you would only have to apply those to a member of staff who was either being paid total remuneration in excess of £500,000 sterling, or was receiving a variable compensation in excess of 1/3 of their fixed compensation. If you meet either of those two tests, you go on to the next stage. Insofar as your US delegate is concerned, the next question you would have is who within my staff are taking or potentially taking material risks with respect to the AIFM and the AIF concerned. So what you're really looking at there probably is the sort of key portfolio managers taking the ultimate decision with respect to the fund, possibly some other individuals, depending on how you structure yourself with respect to the particular fund mandate. The next question you have, assuming you've identified somebody who is taking material risks with respect to an AIF, is what proportion of that person's activities are related to dealing with an alternative investment fund as opposed to dealing with other things. And the remuneration rules, the European remuneration rules, would only apply to that portion of that person's remuneration. And to that extent, the impact could be limited. There's a still further level, which is that these rules apply subject to principles of proportionality, and certainly in the UK, and there may be differences across European jurisdictions on this, but the way the UK is looking upon this proportionality requirement, it has said in its guidance that potentially if somebody is only spending a small part of their time dealing with AIFs and a larger part of their time dealing with other things, then they think that you could disapply the payout process rules, for that reason. So I think there are a number of possible ways of getting out of the worst impacts of this.
Let me ask, do the same rules apply in Germany?
Well, this is an easy question at the moment for us because these rules have not yet been implemented in Germany.
So that's the country you want to go into.
But I mean, the law says, or the Capital Investment Act, which is the applicable law, says that there needs to be some kind of a regulation be implemented in Germany, but that has not yet been implemented. So what our supervisory authority says is we just apply ESMA rules. I mean, that's the paper by ESMA, and it's applied like word by word, so it's a very easy thing for us at the moment. So we just go by ESMA rules. We don't have any specific German rules as to remuneration at the moment. And I would say I haven't really looked into that in depth, but usually it is the case that the UK implements these ESMA rules like as they have to be implemented, and what Philip depicted for the UK should then apply similarly also to Germany.
Well, I mean it's more likely likely that a US manager is going to be sub-advisor to a UK-based investment manager than they are to be sub-advisor to a German-based investment manager? I mean, just because the UK is the more substantial market.
I'm not sure we want to go there. That's for the cocktail session. Just a question. These apply to all alternative investment funds. That'd be private equity, real estate, debt, hedge.
Yeah.
Yes.
Yeah, absolutely. And this is, it's one of the reasons I mentioned about by way of this split in the different regimes. The way it was introduced was to capture everything that wasn't a UCITS fund.
Yeah.
So it is potentially very wide unless you can fall within the de minimis thresholds and come in within the local regimes themselves. And we've been going through a process of education in our various jurisdictions. And even now, because we're still, most jurisdictions, Germany has a slightly different approach, but in the UK, funds have been operating using a transitional sort of arrangement, which won't expire until July. So we still have participants in the London market that haven't quite fully realized the impact of the AIFM directive on their operations, and they generally are in the real estate space, where they thought and continue to think that most of the requirements will not apply to them. And in that space, and also the private equity side, that's where in the UK and other jurisdictions within Europe, I think you find some of the most mystified looks, because they don't really understand why you need a depository in a private equity fund context. What is it you're going to be monitoring in that context? And why do I have to pay more just to have that now? But of course, that is the way the legislation is structured. And it's taking some time for market participants to accept that this is the way things are going to be going forward.
Yeah, the exceptions are really narrow. The other two that haven't been mentioned yet are the single investor funds, funds of one, and separately managed accounts, individual separately managed accounts. Sometimes that comes up as well. The other point that U.S. investment management lawyers, it's a concept that we're not really used to under the Advisors Act, is that under the directive, there's only one AIFM per fund, right? So you don't have to, it's unlike here where if you're an advisor, so you've got a separate analysis under the Advisors Act, so you get multiple registered advisors. Under the 40 Act here, there's only one that gets registered here. So.
Todd, let me ask you, we heard a lot about UCITS and UCITS 5.
Yeah.
What's UCITS 5? We just got used to UCITS 4.
UCITS 6 is on its way. So, yeah, for those of you who aren't familiar with UCITS legislation, as Sean mentioned, it was implemented in the late 80s, and every time they update it, they just add another Roman numeral at the end. We're up to UCITS 5 at this point, with UCITS 6 coming down the road. The final text was agreed to just a couple months ago, and we talked a bit about the remuneration rules, which are going to be a bit troubling. One interesting aspect of UCITS 5 is the remuneration rules, excuse me, don't just apply to the personnel, the identified staff, but they also apply to the compensation paid by the UCITS to the management company as well. I'm not quite sure. I'm looking for the ESMA guidance to see exactly how that works out. But many of the other principles, in fact, if you read the text in the recitals and the explanatory memorandum, there's a lot of references to Madoff and to the Lehman bankruptcy and to the AIFMD. So it's expected to kind of follow that path. The other provisions of UCITS 5 relate to the relationship between a UCITS fund and its, well, we call it here a custodian bank, but a depository there. And again, there's a lot of discussion about Madoff in this context. And a lot of these rules sort of, they call it clarifying, but it really is kind of imposing some additional liability and responsibility on custodian banks, including them making them liable for losses of assets that occur at a sub-custody level, which is a little bit different. So over the next couple years, UCITS managers are going to be reviewing a lot of amendments to their custody contracts. The other provision I thought was interesting was the new UCITS sort of common sanctions regime to sort of create some commonality across the EU for violations of various provisions of UCITS, and I think there's some further guidance to come out on that as well.
Let me just add a bit of a story about the depository liability regime in UCITS 5, because I think this is fascinating. This is an example of how lobbying can sometimes not work the way you'd like it to. As part of the AIFM directive process, people realized, well, hold on a minute, you've got a private fund regime where you're imposing liability on depositories. The liability regime in UCITS 5 is almost identical to the one, it is identical to the one in the AIFM directive. And so market participants started saying, well, how can you possibly impose this more onerous regime on a private fund marketplace when it doesn't apply in the retail marketplace, which is what UCITS funds are directed at? To which the response was, that's a good point. We'll put it into UCITS funds as well. And that's exactly how it wound up in UCITS 5. So I think that's an interesting story.
To my German colleagues here, let me ask you, because I do have some clients that like to enter the German market through consultants and intermediaries, and can that be done, and what effect does that have on the U.S. fund?
Yeah, there's a provision that comes from the directive, if we discuss AIFs, which has been implemented into the German law, saying that if a fund only accepts professional and semi-professional investors, then the rules do not apply, the placement rules. If the investment by the investor is not initiated, as the law says, by the fund manager, but by someone else, i.e., maybe a contact that the fund management company has in Germany, somebody that decides to then maybe introduce that fund, that investment strategy to one of its clients. The question that, of course, arises is how far does it go? I mean, what does at the initiative of the fund manager mean? We tend to take the position that if it's not a structure whereby the only investors that come into the fund then at the very end are they all sit in Germany, and this has been set up as a circumvention, so to say, of the marketing rules. If that's not the case, but you are acting through contacts that you have within your network that also are active in Germany, but maybe not only Germany, but maybe other jurisdictions as well, then we feel pretty safe that that is something that could be done, although BaFin, the German regulator, hasn't really issued any clear guidance on this, on where exactly the boundary runs between marketing at the initiative of the fund management company and the use of your wider network.
Well, they have issued some guidance, which is actually no guidance, which is very general. They say if you don't instruct the consultant, if it doesn't act on your instructions, then it would not be considered to be at the initiative or on behalf of the fund manager. So, as Till said, I mean, it's a question of the factual circumstances, and you probably all know from your discussions with potential investors or with consultants, it can be this way or it can be the other, and we as lawyers, we usually don't want to know how it works. We just give you the legal advice, what can be done or what cannot be done, and here it is really a factual question. And BaFin has issued some guidance that we should probably mention on the MiFID. Which has a similar concept when people come into Germany. That's the so-called cross-border guidance that was issued back in 2005 already. But there, BaFin said if you use consultants as a distribution network, either on a contractual basis or whether it's basically factually you use them, then you would fall under the marketing definition, and that would require you to notify this to BaFin. So if you don't do this, you're fine to do it in German.
Can I add one thing? There's an interesting word by BaFin that said that no marketing takes place. This is something for the private funds, for let's say a private equity fund, whereby it's usual that you distribute your LPA in draft form to investors, and then it's negotiated until you have then a final subscription package. And BaFin has said, interestingly enough, that sending out the drafts is not marketing. because then otherwise you would, each time that you have a second draft circulated, you would then need to go back to BaFin and register again. So BaFin said, no, sending out drafts is not marketing. The question then, of course, arises if you then send out the final subscription package, by when do you then need to register? Because then you might end up never having marketing, because then at the very end, people simply subscribe. That, of course, is something which is not possible. So there needs to be a point in time where registration then needs to take place. But it shows you that BaFin, we think, is still themselves uncertain as to where exactly they want to require these placement rules to apply, or by when.
There's a question.
Sorry.
Does your answer change if the consultant in country is affiliated manager?
I would probably say yes, because then, as Christina said, it's more difficult to then say it's not at the initiative or not by instruction if it's the parent company, for example. I mean, how can you then say it's not at the initiative if your parent company is the fund manager?
Are there any more questions for the panel? Down, yes, Paul?
Have other countries adopted a similar marketing rule where marketing only begins at a certain point when you deliver documents? I know from speaking with Philip that in the UK it's a pretty generous regime for sponsors. What about other jurisdictions?
Well, I was going to you took the wind out of my sails there by mentioning. I thought Germany was different, but obviously recently this guidance has come out from BaFin, and I don't know whether BaFin was influenced at all by the way the FCA has approached this. What I think there is a certain logic in the position that you're not offering under the directive until a point at which you have relatively final documentation, because in order to meet the requirements to notify or register or whatever you need to do in each particular jurisdiction, you have to have the requisite disclosure requirements in your prospectus. So it stands to reason that if you're marketing on the back of a teaser or slideshow or something, that you're not going to have got to that stage in the process. So I mean, I think the logic of that is quite nice, and actually one would think that most jurisdictions will ultimately follow that line.
They should.
They should, although as I understand it, France and Spain are likely to diverge from that.
Okay, any more questions? Well, I think it's cocktail hour now. And the debate, the Singapore-Hong Kong debate, the Germany-UK debate can continue on. So please join us for cocktails, and let's give a good hand to all of our panelists. Thank you for coming.